Ethereum is at a pivotal point. On the one hand, the SEC has been cracking down on staking and proof-of-stake cryptocurrencies, and it's believed that a crackdown on DeFi and stablecoins is imminent. This could do indirect damage to ETH. On the other hand, institutional adoption of Ethereum has been on the rise, and in the coming months, it will undergo an upgrade that could take almost all the market share away from competing Layer 1s. So in this video, I'm going to bring you up to speed on Ethereum's most important updates, analyze ETH's price action, explain its upcoming upgrade, and tell you why ETH could be on the brink of a boom or a bust. I'll start by saying that nothing in this video is financial advice. It's purely for educational purposes, and you should consider it to be just one of many resources you ought to be consulting on your crypto quest. Also note that I and other team members here at Coin Bureau hold ETH in our personal portfolios, but we promise we'll be as unbiased as possible. Now, it's been more than 5 months since our last Ethereum update, and a lot has happened since then. Shortly after that video went live, borrowing and lending protocol Aave launched its V3 version on Ethereum, theoretically leading to more ETH demand from crypto lenders and borrowers. More about Aave in the description. I digress. Then, in early February, Russia's largest bank, Sberbank, announced that it would be launching a DeFi protocol on Ethereum by May this year. Now, we couldn't find any news of the protocol deploying, but it is nonetheless a sign of continued institutional adoption of Ethereum, for better or for worse. Ethereum co-founder Joseph Lubin also declared that ETH is not a security. Now, this was believed to be in response to the rhetoric from SEC Chairman Gary Gensler, who implied that ETH was a security back in September on the same day of Ethereum's transition from proof-of-work to proof-of-stake. In retrospect, however, it seems the declaration foreshadowed an SEC crackdown on the staking services offered by cryptocurrency exchanges. That's because a few days later, Kraken announced that it had settled with the SEC for offering staking services, which the regulator believes are securities offerings. In mid-February, there was speculation that the SEC would use the precedent it had set with Kraken against liquid staking protocols like Lido Finance. In retrospect, it seemed to foreshadow a crackdown on Coinbase, which was sued early last month, due in part to the staking services the exchange offered. There was, however, a silver lining in the midst of all this mess, and that's that the number of OFAC-compliant blocks on Ethereum's beacon chain had fallen below 50%. For context, over 70% of Ethereum's blocks were enforcing sanctions after the merge. Today, this figure stands at less than a third, censorship resistance, up to a point. In March, Ethereum developers announced that EIP 4337 had been successfully implemented. EIP 4337, also known as Smart Accounts, makes it possible to introduce features on Ethereum that will lead to mass adoption, such as dApps with no gas fees and making mobile wallets as secure as hardware wallets. You can learn more about why EIP 4337 is such a big deal for Ethereum by checking out our in-depth video about it on Coin Bureau Clips. The link will be down in the description. Now, because the universe requires that all FOMO be balanced out with FUD, rumours started to circulate that Lido Finance had been served by the SEC in the days that followed EIP 4337. Lido subsequently announced that it would be incorporating NFTs into its unstaking process for liquid staked ETH. This is interesting because NFTs have received next to no regulatory scrutiny for whatever reason. As such, Lido leveraging NFTs could have been a move to protect the protocol from said regulatory scrutiny. This could be circumstantial evidence of the rumour that Lido was in the SEC's crosshairs, a rumour which seems to have been just that. That being said, Uniswap v3 also represents liquidity provision positions as NFTs, and Uniswap founder Hayden Adams recently posted an ominous tweet thread. Probably nothing. Anyways, in mid-April, Ethereum finally completed its Shapella upgrade, making it possible for validators to withdraw their staked ETH and staking rewards. For reference, Shapella had experienced some delays, and there were concerns that the upgrade would result in lots of ETH selling, which could crash its price. In the end, these concerns were entirely unjustified. Although there was some ETH selling after the upgrade, ETH's price was unaffected. In fact, ETH's price pumped in the days following Shapella, presumably because the upgrade had been a success. It also effectively completed Ethereum's transition to proof of stake. But because the universe requires that all FOMO be balanced out with FUD, the SEC announced 2 days later that it would be proposing a rule to expand the definition of exchange to include DeFi protocols. The comment period for the proposed rule closed on the 13th of June. If it is implemented, DeFi could be in trouble. Continued regulatory uncertainty around the crypto industry is probably why institutional investors have reportedly been getting exposure to ETH via indirect products like ETH futures on the CME. Institutional interest in ETH has surged in recent months, but it seems most investing has been indirect. Now, this could have less to do with the regulatory uncertainty around ETH and staking, and more to do with the fact that regulators have been picking off crypto to fiat on and off ramps left and right. Obviously, the last thing institutions want to do is invest in ETH directly and not be able to cash out. That said, some institutions haven't caved to these regulatory concerns. At the end of April, a subsidiary of French bank Société Générale announced the launch of a euro-pegged stablecoin on Ethereum. Meanwhile, retail investors were going crazy trading meme coins like Pepe. Feels just like yesterday. In May, though, the FUD came back with a vengeance. First, it was reported that the Ethereum Foundation had sold some ETH. This was taken as a sign that ETH had hit a local top, given that the foundation does have a history of selling around local tops. Of course, it doesn't have a perfect track record in this regard. Nobody does. Then, less than a week later, Ethereum's beacon chain experienced unexpected finality issues. In plain English, transactions couldn't confirm. Funnily enough, it's believed that the meme coin craze overloaded some Ethereum clients. Whatever the case, the beacon chain was quickly upgraded and all was well again. That was until late May, when Vitalik warned the Ethereum community in a lengthy blog post not to overload Ethereum's consensus mechanism. The TLDR is that putting too much functionality directly on Ethereum could compromise its security, a claim that's been made by many in the Bitcoin camp. 1 week later, Ethereum wallets that had been dormant since the crypto project's ICO days started to move their ETH to new wallets. Thankfully, it seems none of this ETH was sent to exchanges. If it had been, it would have signaled an intention to sell by some of Ethereum's earliest investors. Unfortunately, the same can't be said for Ethereum co-founder Jeffrey Wilker, who sent 22,000 ETH to Kraken in early June, presumably to sell. To put things into perspective, this accounted for more than 10% of Jeffrey's ETH holdings, and he hadn't sent any ETH to exchanges in over 2.5 years. Fortunately, though, the universe also requires that all FUD be balanced out with FOMO. A subsidiary of the Bank of China reportedly issued almost $30 billion of tokenized assets on Ethereum via Hong Kong. This was done with the help of a Swiss bank, underscoring institutional Ethereum adoption in both regions. Then, in late June, Ethereum developers announced they were discussing the possibility of raising the maximum validator stake from 32 ETH to 2,048 ETH. Naturally, this was met with no shortage of FUD, namely centralization concerns. When you think about it, however, you start to feel massive FOMO. For starters, the minimum 32 ETH stake will stay the same. All that's changing is the maximum stake, which is currently also 32 ETH. Now, this is a problem because it means that validators have to redirect their staking rewards to other Ethereum wallets. They're not able to accrue them in the validator wallets. Raising the maximum stake to 2,048 ETH means that validators will be able to accrue staking rewards, and it will also open the door to automatically restaking these ETH rewards. Compounding, in other words. Given that there's nothing institutions love more than earning yield, this would likely result in even more ETH being staked. The trade-off is that the total number of validators on Ethereum could decline. But consider that Ethereum's beacon chain currently has over 700,000 validators. In theory, more validators means more decentralization. In practice, however, more validators could mean more synchronization issues. The optimal number of Ethereum validators is up for debate. But what we can all likely agree is that there is such a thing as too few validators, but there's also such a thing as too many. The golden number is somewhere in the middle, and the 2048 ETH limit is probably intended to target that number. Never mind that the number of validators isn't always the best measure of decentralization. More about that in the description. Anyhow, speaking of staking, Vitalik recently revealed that he's only staking a, quote, small portion of his ETH. He said this is because of security issues associated with staking and the complex multisig setup required to address them. Creators of competing Layer 1 cryptos were quick to criticize, not going to name names, of course. Now, while I'm not qualified enough to speak to the security issues associated with ETH staking or setting up complex multisigs, I do have a feeling that this might not be the only reason why Vitalik isn't staking too much of his ETH. Another reason could be taxes. Try explaining staking income to the taxman. Regardless, there's no denying that Vitalik's comments don't inspire too much confidence about staking ETH. As was mentioned in our weekly news review, however, this is a part of Ethereum's growing pains. Staking issues ultimately mean that we're still early and that ETH still has a lot more room to grow. On that note, you might have noticed that ETH is up almost 2x since the start of the year. This is due to a combination of macro factors, crypto factors, and fundamentals such as ETH supply and ETH demand. The primary macro factor has been liquidity, which had been positive for the first half of the year. For those unfamiliar, liquidity is another word for money that's in the markets. Liquidity had been on the rise since January because the debt ceiling had been reached. This forced the US government to spend money in the economy as it couldn't issue debt. There was also that de facto bank bailout in March as well. Today, however, the liquidity picture looks a bit more mixed. Banks are reportedly borrowing billions through the Fed's BTFP facility, which is likely increasing liquidity. At the same time, however, the US government has been issuing billions of dollars of debt to refill its bank account at the Fed, which is likely draining liquidity. If you watched our video about the refill of the US government's bank account, you'll know that this could suppress ETH's price the same way it did during the refill in early January 2022. Thankfully, this hasn't happened, and that's probably because the liquidity drain has been coming from elsewhere. As far as crypto factors go, there are two which have been affecting ETH's price. The first is the aforementioned Shapella upgrade, which was, by all accounts, a great success. As you can see, ETH's most recent high of around 2.1k was reached on the same week that Shapella went live. The second crypto factor that's been affecting ETH's price is regulatory uncertainty. At first glance, this hasn't had much of an effect on the price, but when you measure ETH's price in BTC terms, you can clearly see that it's been underperforming despite the impressive pump in fiat terms. The bad news is that ETH's underperformance against BTC is likely to continue until there's more regulatory certainty in the US and elsewhere. The good news is that ETH could still see impressive gains in fiat terms. This assumes the crypto market will continue to rally. Let's hope that it does. When it comes to fundamentals, ETH's supply has been deflationary. More ETH is being burned via transaction fees than is being minted via staking rewards. The caveat is that ETH's deflationary trend seems to be reversing. If this continues, ETH could become inflationary again in the coming weeks. Now, this shouldn't be a problem because ETH demand continues to be robust. The amount of ETH being staked continues to rise, along with the number of validators. The number of unique wallets on the Ethereum blockchain also continues to be in a strong uptrend, 240 million and counting. At first glance, the declining number of daily transactions on Ethereum is a bearish sign. That's until you remember that Ethereum has an entire ecosystem of layer 2s that's been growing fast. Lo and behold, the number of transactions on these layer 2s has been spiking, more than compensating for the shortfall. Now, this raises the question of whether all the layer 2 activity is enough to create demand for ETH, given the low fees on these layer 2s. The answer is yes, if there is enough activity on these layer 2s, and so far, this seems to be the case. Even so, the gradual decrease in ETH burns could be a sign that activity as a whole is slowly declining. Then again, all it takes for this activity to pick up again is another trend, be it a meme coin craze or a reissued NFT collection, for example. These kinds of catalysts are impossible to predict, which is why it's better to focus on upcoming milestones for Ethereum that could send ETH's price higher. As it so happens, there are two. The biggest upcoming milestone for Ethereum is the EIP 4844 upgrade, which is colloquially referred to as proto-dank sharding. The reason why proto-dank sharding is a big deal is because it will basically allow Ethereum to reach a level of scalability that's comparable with centralized computer systems. This will be achieved by addressing Ethereum's main bottleneck to scalability, which is data availability. As explained by Ethereum developer Proto in a presentation, this is because it's hard to request transaction data on a cryptocurrency blockchain in a way that's both fast and decentralized. Proto-dank sharding solves this by making it possible for special blobs of data to exist on the Ethereum blockchain. These blobs make transaction data more readily available, which should increase Ethereum's scalability, lower its fees, and increase transaction speeds on its layer 2s. That's the simple explanation. Be sure to watch Proto's presentation if you want the complex explanation. The link will be in the description. Now, proto-dank sharding was first proposed as an EIP in February 2022, and Ethereum developers have been working on implementing it since then, primarily developers from the Optimism Layer 2. EIP 4844 is expected to be implemented sometime in the second half of this year, but no exact date has been given. Besides proto-dank sharding, Ethereum developers have apparently been hyper-focused on privacy. Back in January, Vitalik penned a blog post where he referred to privacy as, quote, one of the largest remaining challenges in the Ethereum ecosystem, and proposed stealth addresses as one solution. In April, privacy on Ethereum came into the spotlight again because of supposed privacy concerns related to ETH staking. Just last month, Vitalik penned another blog post where he noted privacy as being one of the, quote, 3 transitions that Ethereum must implement or else it will fail. The sudden focus on privacy is not all that surprising when you realize that institutional investors want privacy more than anyone else. And remember that the Shapella upgrade has increased institutional interest in ETH. The trick is to implement this privacy in a way that doesn't get ETH delisted from exchanges. In case you haven't noticed, crypto privacy isn't all that popular with regulators, regardless of the country, and even regardless of the cryptocurrency. Case in point, Litecoin was delisted from South Korean exchanges after it implemented its privacy-preserving sidechain last year. Litecoin. The unprecedented regulatory environment we've seen since the start of the year is only going to make implementing privacy on Ethereum that much more difficult. This is probably why Ethereum's privacy solutions have centered around layer 2s, but this could still cause issues, as we've seen with Litecoin. This brings us to the challenges Ethereum faces, and the first is regulation, or rather, lack thereof. Until there's regulatory clarity in the US and elsewhere, it's going to be hard for ETH to reach its new all-time highs. That's because institutional investors will be hesitant to deploy capital directly into ETH. It's not just the institutional investors either. It looks like retail investors risk losing access to things like staking, and not just in the US. Singapore is reportedly discussing a proposal that would prevent retail investors from staking, and countries such as Canada have introduced limits on retail crypto investing. For what it's worth, any regulation will be good regulation in the long run. That's because as soon as a baseline has been established, institutional interests will be able to lobby regulators in the direction they want regulations to go. We believe that institutions will eventually lobby to preserve on-chain privacy. This will benefit retail investors, but it assumes they won't be completely priced out of these privacy layers. And this ties into the second challenge Ethereum faces, and that's centralization. Not at the base layer, but at the layer 2 level. You see, as Ethereum fees continue to rise, layer 2 usage will increase. As we mentioned in our video about Bitcoin's ordinals NFTs and BRC20 tokens, most layer 2 scaling solutions, including Bitcoin's Lightning Network, are surprisingly centralized. This means that they're not all that different from the existing financial system, and this is where many retail users could end up. This is a problem because it means that retail crypto users could eventually lose their financial freedom on-chain. It would defeat the entire purpose of cryptocurrency. Take a second to consider that Coinbase's Layer 2 scaling solution for Ethereum will reportedly be compliant with AML regulations. The trade-off in this case is that regulatory compliance will make these Layer 2 scaling solutions that much more appealing to institutional investors. Some would say it would be rational to take any gains made from these Layer 2s and stick them on a Layer 1 that can't be as easily controlled, but hey, who knows? And this relates to the third challenge Ethereum faces, and that's competition. If retail users do get priced out of using Ethereum itself, they could start switching to Ethereum competitors to ensure that they retain their financial freedom on-chain. This could also happen for other reasons, such as staking issues. From our perspective, however, the biggest blow to Ethereum would be if something happened to its more centralized middleware. I'm referring to Ethereum infrastructure, such as Infura, which has a history of complying with US sanctions. Infura has also experienced outages on 2 occasions. Now, for those who don't know why this is such a big problem, Infura provides RPC endpoints for MetaMask, one of the most popular Web3 wallets in the world. Both Infura and MetaMask are operated by a centralized company, Consensus. Joe Lubin happens to be the founder and CEO of Consensus, and you'll recall that he's been reiterating that ETH is not a security. Consensus itself has also been issuing similar statements and recently spoke out against the SEC's DeFi rules. On the off chance that the SEC is insane enough to go after ETH, Infura could restrict retail Ethereum usage in the US. The worst part, though, is that the SEC doesn't even have to go after ETH to do damage. If the exchange definition is expanded, Infura and MetaMask could again be in the crosshairs. Believe it or not, but if either of these black swans did happen, it would be bullish for Ethereum in the long term. That's because it would force the entire Ethereum ecosystem back towards decentralization, something that's been slowly happening ever since regulatory scrutiny of crypto began last year. Obviously, these black swans would be bearish for Ethereum in the short term, but the silver lining is that it would be even more bearish for competing Layer 1s, which are facing even more regulatory scrutiny than Ethereum. This could paradoxically result in more money flowing into ETH from other alts. This is all but guaranteed if proto-danksharding delivers on its promises. The only reason why there are competing Layer 1s is because Ethereum isn't cheap or scalable enough for most people to use. This will change after EIP 4844 is implemented, and it should result in significant flows into ETH from other Layer 1s. In sum then, Ethereum is truly at a crossroads, with unreasonable regulations on one hand and unprecedented adoption on the other. Regardless of the path it goes down in the short term, the long-term destination is the same: ETH reaching new all-time highs and revolutionizing the financial system. And you can find out how high institutional investors think ETH will go using the link in the description. And that's all for today's video, folks. If you found it informative, let me know by smashing that like button. If you want to make sure you don't miss our next crypto update, subscribe to the channel and ping that notification bell. If you know any ETH or BTC maxis, why not share this video with them and piss them both off? And if you're looking for a safe place to store your ETH or somewhere to trade it without getting wrecked by fees, check out the Coin Bureau deals page. It's got the biggest discounts on the best crypto wallets and up to $40,000 of bonus airdrops on the best crypto exchanges. The link is, of course, in the description. Thank you all for watching, and I'll see you next time.